Good morning, everyone. My name is Jeffrey Scott, and welcome to home lending and the mortgage process. I kind of like to start off the conversation with a trivia question, and you can use your chat box for this. How many people do you think it takes to fund a home loan from start to finish? How many different people do you think are involved in that one home loan? Good afternoon. I was just talking to someone in the chat. Any guesses? Any estimates on that? Okay, well, I don't see anything coming in. So, okay, there's one, 6. All right, fair. 6 to 10, maybe. Believe it or not, I can easily count 18 different people that are associated in a home loan process. I'll just shoot through them real quick. The loan officer generally starts it. Then there's an assistant loan officer that will help gather the loan documents that are required. There's a processor involved, and there's generally a junior processor that's doing some background work on verification checks, such as employment checks and address LOEs, which is letter of explanations, etc. There's an escrow officer. There's the escrow officer's assistant. There's the title officer. There's the appraisal management company that's the go-between between the lender and the ultimate appraiser. There's the appraiser. There's the lender review, appraisal review department, because what happens is that when appraisers are doing these appraisals, they're doing so many of them and so quickly that there can be mistakes in them. So the lender ultimately can't sell the loan to Fannie Mae or Freddie Mac in the event that there's a mistake in the appraisal. So we catch those mistakes up front and get them corrected, saves time and energy. There's a fire insurance agent that's involved in the process. If there's a condominium, there's an HOA association. And then once we get what's called CTC, which is clear to close, there's a funder. And then we have got a wire department to wire funds. And then there's, of course, the notary who helped the borrower sign the documents, and then finally it's recorded at the county, and these are all individuals that participate. So it gets to be a pretty big process. So my name is Jeffrey Scott, and I've been a loan officer for 18 years. It's very simple for me. It's a simple process. And I promise to make it very simple for you, because I think at the end of the day, it takes a lot of stress out of it for your borrowers. The loan process itself is can go as fast as the customer can go. Where the customer generally becomes frustrated is when the lender keeps coming back and asking for more documentation. And there's actually a reason behind that, but there's also ways to prevent that from happening. So the reason behind that is because when we, not one size fits all borrowers. And so if I ask a borrower for 2 years of tax returns and 2 years of pay stubs and 30 days of pay of their pay stubs, then it turns out he's a self-employed borrower, that triggers the need for profit and loss statements as well as business tax returns. So that's where the rub actually comes. So if we do our due diligence up front with the customer, we can prevent a lot of that. And we pride ourselves in doing that due diligence up front, because I don't like to upset customers. I would rather give them the kitchen laundry list to provide those documents so we know exactly what we need, and then it's just up to them. And really their job, if you think about it, is super simple. All they're doing is photocopying documents, or they are scanning documents in for us, or they are getting those documents off their website, or, like Bank of America's website or Wells Fargo's website, or whatever banks statements that they need off those banking institutions' website. Is it tedious? Yes, it is. Does it frustrate people? It can. Should it? No, not really, because it's super simple if you really think about it. So let's get into this. I would like you all to take my email address down and my cell phone number real quick. I'd like you to feel free to call me with your loan scenarios and your loan questions. Every realtor that I have dealt with has different borrowers with different needs. They might be jumbo borrowers that have a specific group of needs. They might be a conforming borrower. They might be a down payment assistance borrower. They could be a self-employed borrower versus a W-2. These are all different layers of complexity. And when dealing with borrowers or loan scenarios, please reach out to me, shoot me an email, shoot me a text, give me a telephone call at any time, and run it past me. Like I said, I've been doing this for 18 years. It's super simple for me. I promise to make it super simple for you. And I work pretty much 7 days a week, 24/7. So I've got customers on the line at 10 o'clock on Sunday nights asking for pre-calls for Monday morning. And that's just the way we operate. And I'm glad to help. So keep that in the back of your mind. I'm going to walk you through the loan process. I'm going to show you what the uniform loan application looks like today. In the old days, we called it a 1003. The 1003 was 4 pages, super simple. Today, it's grown to 8 pages. This was all after the mortgage market meltdown of 2000, late 2006 and all of 2007. And what came from it were the TRID laws. And when the TRID laws hit by 2015, we had rolled out a whole new set of ways to manage the loan process. This document today is generally completed by the customer online. We send them a link. If you want to jot my link down, it is www.applywithjeffrey.com. That's called a vanity link. That simply means that link, that www.applywithjeffrey.com, will direct the customer to New American's bank website. It's a secure web portal. It's a microsite of mine. So they could start the loan application, and all lenders would start the loan application. I'm sorry, all borrowers would start the loan application there. The process for lending starts with that application and then moves to us gathering the financial documents. Now, this is where, if you do a good job of gathering the financial documents, which I assure you we do, because this is what professionals do, they do it right the first time. We would start with the property, and I like to lump these in 3 different categories so you can kind of remember these in the back of your mind when you're talking to your borrower. Well, there's 3 categories of documents that are needed. There's the properties documents, there's the income documents, and then there's the asset documents or your bank statements. So underneath those sub categories, the property, you have fire insurance. If the property is a refinance, we're going to have a loan statement. If it's not, they wouldn't. The property will have a tax bill. And then if there's an HOA on the property, then there will be HOA documents. And that pretty much takes care of the documents for the property. On assets or bank statements, what we like to collect is 60 days or 2 full months of checking accounts, savings account, or money market accounts. Those are called your liquid assets. We need all pages of the statements and even the blank pages of the statements. And the reason why we need the blank statements, the blank pages, is because the underwriter doesn't know they're blank. We have to show them that they're blank. So that is a challenge with certain customers. And then if it's a retirement account, such as a 401k, a SEP, an IRA, a Roth IRA, etc., it's a 90-day statement. So generally speaking, those are quarterly. So we'll take one quarterly statement, most recent quarter. But if they're not quarterly, then it's going to require 3 monthly statements. Then the income section is super simple. It's 30 days of the pay stubs for both borrowers. It's 2 years of W-2s or 1099s if they are self-employed and they are their employer gives them a 1099. I think most realtors, I think all you guys are 1099. So that's what you see at the end of the year. And then if you own a portion of a company, then, or all of it, then K1s would be distributed. So we'd be asking for those. Depending on the loan, so you have conforming loans, you have high balance loans. Those are both Freddie Mac and Fannie Mae. And then you have jumbo loans. But so depending on the loan amount will dictate whether or not we need tax returns. So do I ask for tax returns up front? Not always, but when I can predict that we're going to need tax returns, then we obviously will ask for tax returns. And then if the customer happens to be self-employed and owns his own company, even if he's W-2'd, we'd still need 2 years of his business tax returns to show that to show his income, to verify his income. Other documents that we don't think about often, but will often need would be bankruptcy documents if they have undergone a bankruptcy in the last 7 years. So we'd need the settlement. If there is a divorce, then a lot of times we'll need the final divorce decree. The reason we're looking for that is because if they're paying alimony or child support, that's not going to show up anywhere except in that divorce decree. So that's kind of a document that's overlooked sometimes, but super important to get up front. And it's on the questionnaire if they were married or unmarried. And if you're unmarried, the very first question is have you unfortunately been divorced? Because then it triggers the need for that document. So those are the documents that are gathered. Again, super simple, but this is where it can rub the customer because we're collecting so much. But I always tell my customers, hey, this is a super easy process. All you're doing is scanning documents, or you're getting documents off the internet and emailing them to us, or you're uploading them. Once this is done, all the heavy lifting's in our court. So just get me those documents and we'll power through this and get your loan to the underwriter and through the system as quick as possible. So that brings us to the loan process in itself, by itself. So the very first thing that as a loan officer and a loan officer assistant, once the loan is packaged and prepared and ready to move to the next stage, it goes to a processor, and the processor is going to do a variety of background checks and verifications and employment verifications. And we're going to look for anything that might need a clarification to the borrower, to the underwriter, and we're going to write those letters of explanation up front. So they could be simple explanations like they just changed banking accounts, and here's the old banking account, here's where the money came from for the new banking account. It could be the divorce situation. It could be a business. There's a million different reasons to write LOEs, addresses, varying names or spellings on names, et cetera, et cetera. If we do those things up front, then the underwriter can go right through them, understand the file, and not ask for those to be gotten later. And so again, a good loan officer, a solid loan officer, is going to be able to predict all the things that the underwriter is going to need up front and do the job right first. And then it just makes it's like putting a choo-choo train on the tracks. If it's put on the tracks properly, it goes right down the tracks easy. But if it's just thrown onto the tracks and takes off, it gets wonkus quickly, and then it's painful to get it back on track, if that makes sense. So Once the processor finishes their processing of the file, it moves to the underwriter. And the underwriter basically, this is pretty fascinating, actually. So Fannie Mae and Freddie Mac have a book of guidelines. It's 1,200 pages, both of them. They're different guidelines for both institutions. And think of the guidelines as the rules to any game that you like. So whether you're a football fan or a basketball fan or whatever, all those games have rules. And if you follow the rules, you don't get penalized. But if you don't follow the rules, then then you would get penalized. So the underwriter is in charge, basically, of making sure that the loan meets those 1,200 pages of guidelines. So that's a big task, right? Now, the underwriters it takes years of training and they're highly paid, and they reference these 1,200 pages of guidelines. They're in and out of them all day long for different scenarios to get a loan approved. And once it goes through underwriting, there's what's called the first pass. And the first pass will give us an approval with conditions. Okay. And so what that's going to say is, okay, this borrower is approved for this loan, provided they meet these conditions. Now, those conditions could be as simple as they're missing page 8 of their bank statement, or it could be more complex to explain why the K1s are not matching up, or that you actually own 25% of another business buried inside your tax returns that weren't uncovered. And so we need to then go and document those documents to meet the conditions of the guidelines. So again, my goal as a loan officer is I want a one pass. Now, one pass is really difficult, and I've only done it probably 1 or 2 times in all those 18 years, because you got 1,200 pages of guidelines to know. But one passes are possible if you really have a super tight file, and that's what we shoot for, because I don't want to go back to the customer and ask for 20 more documents if I've just asked for, if I ask for 5 documents going into the transaction and then ask for 25 after the loan has been underwritten, which is what most lazy loan officers do, unfortunately, then it just upsets the borrower and slows the process down. I'd rather ask for all 30 of the loan documents up front, document everything tightly, and then when the underwriter sees my file, the underwriter says, oh, that's from the Jeffrey Scott Group or whomever. They write tight files. I'll take his first, knock it out of the way, and go on to the more sloppy files. So you earn a reputation by doing things right the first time, and then you build these great relationships with your underwriters. So then you can get them actually on the phone and, and say, hey, Karen, I know I missed this document. I'm going to squeeze it in later. Or, hey, Karen, do you see where I'm going with this letter of explanation? Does it make sense with you? And if we're doing things right, the underwriters want to make loans. They don't want to make bad loans, but they definitely want to make loans. So I'm really proud of the way we build our files, and I'm really proud of the relationships that I have with my underwriters. And whoever you guys use, even if it's not me, which is completely fine, make sure you're using someone that knows what they're doing, because there is so much slop out there. It is embarrassing, and it drives me crazy. I just really like things tight going into it, professional. Treat your customers professional, treat your underwriters professional. Don't throw junk against the wall and hope it sticks. And that's what this is all about. Once the underwriter gets to, once we meet all those conditions, then the underwriter is going to issue what's called a clear to close. The CTC is our celebratory initials, clear to close, CTC. Once we get CTC, it's a mad dash to order the loan documents, get the loan documents to our escrow officer and our funder. The funder actually prepares the documents, sends them to escrow. There's a balancing of the CDs. Once that's done, the escrow officer hires their notary. The notary goes to the customer's house or office, signs the loan documents. The notary gets the documents back to us via overnight, and the funder will fund the following day and actually record in Orange County. We can fund and record in same days. So that's pretty much the loan process. Any questions? Pretty straightforward, pretty simple, step by step. I can't get to a funder until I've gone through underwriting. It all hopefully makes sense to you guys. No questions? Cool. Again, if you are thinking of questions that you have that might relate to a borrower or a customer of yours, feel free to put those in chat, or not sure if we can get you off mute, but at least we could knock those questions out in chat, because I know that it's a very big arena, the lending side and loan structuring, and then the different types of loans that are out there. So any questions you guys have, email me, text me anytime, and I'll help you out. Okay, so what I've done is walk you through the loan process and the types of documents that need to be gathered. And the reason I did that up front, not only because it's the beginning of the loan process itself and the start of the loan process, but it sets us up for this next conversation, okay? And this next conversation, I'm going to explain to you. First of all, I'm going to talk a little bit about the institutions that are available to all consumers today. For example, you could go straight to Wells Fargo, straight to JP Morgan Chase, straight to Citibank, or any large institutional banking, and they will have their Fannie Mae products and their Freddie Mac products, and which we all have, and they will have their jumbo products, which we all have. Now, the difference is that these banking institutions all have to negotiate with Fannie Mae and Freddie Mac, and a lot of times they're ultra conservative. So they're going to place what's called overlays onto that 1,200 pages of guidelines. So the guidelines might say you need a 720 credit score for this particular loan document, but JP Morgan Chase's overlay says you need a 740. So what happens is the banking institutions choke down these 1,200 pages of guidelines, and they do it for a variety of reasons. One of them is that these are all pre-negotiated with Fannie Mae and Freddie Mac, but also they may not want to play in a more aggressive arena where there could be buybacks. And what a buyback simply means is that the bank does a loan, they package it all up, they sell it to Fannie Mae or Freddie Mac, and Fannie Mae or Freddie Mac look at it and say, nah, I don't like that one because you didn't meet my guidelines. You didn't meet my 1,200 pages of guidelines. And so there could be some negotiation between Fannie Mae and Freddie Mac and the lender, and it might get bought and it might not get bought. But the fact of the matter is the banks are ultra conservative, and they do not want to hold 30-year fixed rate money on their books ever, because it's a losing proposition. And that's why we have Fannie Mae and Freddie Mac, because they are technically GSEs, a government-sponsored entity. They're not owned by the government, but they are sponsored and directed by the government for the good of all Americans who want to buy a home. So So these institutions, and then another type of institution would be like us, New American Funding. New American Funding is the 13th largest mortgage bank, privately owned in the United States. We do not do car loans. We do not do credit cards. We do not accept checking accounts or savings accounts, and we don't offer CDs. We strictly do mortgages, and the only type of mortgage we do is residential mortgage. So our ultimate customer at the end of the day is the borrower and Fannie Mae and Freddie Mac, or our institutional jumbo investors. The cool thing about New American is that we're owned by one lady. Her name is Patty Arviello. She's a billionaire. She doesn't have to work. She's owned the company for 30 years. What's cool about her is that she's a champion of families who want to buy a home. And what a champion means in our world is that we offer all of the loan silos that I'm going to go over today. And when we compare these loan silos to Wells Fargo or JP Morgan Chase or to Citibank or the big money center banks, they don't offer everything. They only offer what they're good at and what they can do, and that meets their risk buckets or their risk parameters. Our organization will look at that 1,200 pages and not have any overlays on it. So we would be considered the most aggressive lender in the marketplace, which is the best for the customer at the end of the day. But we know that if we meet those guidelines, that the Fannie Mae and Freddie Mac will buy the loan from us. So we're a very streamlined shop that focuses on efficiencies and doing things right in just the space of home lending. So what that means to you at the end of the day is that we offer all three loan silos, and I'll walk you through those now and kind of explain them, because I find them super fascinating. If you have questions, jump in. But the goal is to have a loan for any consumer that wants to buy a house at the end of the day. So the first silo I like to affectionately call a tax return silo. And what I mean by a tax return silo is that the loan itself is going to require, if it is required, your tax returns to prove your income. Now, a lot of customers think that equity in their home is a way to repay, because they just feel that, hey, if I only have 50% debt on my house, then it's a secure loan, so you should take my loan. That's not what the banks look for. The banks look for cash flow, monthly cash flow, monthly predictable cash flow, monthly cash flow that has a history of 2 or 3 years or 20 years. Cash flow is the only thing that they're looking at. The other things like low loan to value or high equity, or if the guy's got $3 million cash in the bank and could write a check for the whole loan, those are simply compensating factors. They are not going to make the loan. So tax return loans are going to require the tax returns. Fannie Mae and Freddie Mac will always, well, this is where it gets a little interesting. In the event they need tax returns, they will always require tax returns, but the underwriting algorithms on the computer systems today, generally, if you're a W-2 employee and you've been there a couple years and you've got strong reserves and a strong FICO score and you don't have any BKs, and you're a pretty good credit risk, they could waive tax returns, and we see a lot of tax returns being waived, but you're still going to need 30 days of pay stubs and your W-2s to meet these tax return style loans. When the 2006 mortgage market meltdown hit, and in 2007 it started burying banks, the result of that was by 2008, the TRID laws. And the TRID laws rolled out in 2015, so we call it the 2015 TRID Act. And one of the things that came out of those laws was the ability to repay, or the proof was, the burden was on the lender to prove that the borrower could repay. So there was no more stated income loans, there was no more stated asset loans. They felt that that was not, it didn't do us any good. It brought us on the brink of a collapse is what it did. We did not collapse thanks to the government, but it was that was truly a meltdown. And so in Silo 1 today, the TRID laws now require us to prove the ability to repay. Some of the things that you cannot have in a loan today that we used to have back then is negative amortization, which was really an investor loan at the end of the day, but it got pushed into the consumer bucket and probably shouldn't have, but it did. And that's that stated income, stated asset, countrywide, negative amortization loan, and all the other lenders. I shouldn't pick on Countrywide because there was a billion of them out there doing that, is what really got us in trouble at the end of the day. So there's no negative amortization anymore. There's no prepayment penalties on this style of loan anymore. There are no balloon payments, so it can't be due in 5 years or 7 years and be forced to repay it. So you're facing a mandatory refinance or a mandatory sale of the property to repay it. The loan term can't be longer than 30 years. And there's these new maximum debt to income ratios, which is pretty interesting. In some loans, it's 43% maximum debt to income ratio. Other loans, it's 45%. Now, that's not to say I can't get you to 50% on a case-by-case basis, but there are these laws that are now in place that state 43 and 45 is your maximum debt to income ratio. And then there's also limits on what the bank can charge the customer at the end of the day for points and or expenses. And so there's no, it's not the wild west like it used to be. On those amortization or on those negative am loans in the old days, you could charge the customer 2 points up front and then have the investor pay you 2 points more when a loan is sold, which ultimately the customer was paying for. That's all been wiped off the face. So just remember 3% as the max for these TRID loans. Now, what happens if the customer cannot show you bank statements to prove their income, to prove their ability to repay? Well, that's opened up a whole new genre of lending. And what I like to affectionately call this is non-tax return loans. So silo number 2, tax returns are not a requirement to get the loan. But the ability to repay is still a requirement. So silo number 2 still falls under the TRID laws, but silo number 2, I like to call Wall Street money, because that's technically what it is. Silo number 1 is Fannie Mae, Freddie Mac, and jumbo investors, tax returns. Silo number 2 is no tax returns and Wall Street investor money is where this pool is generated from. And these mortgage-backed securities are packaged and traded not to Fannie Mae and Freddie Mac, but outside of it on Wall Street. And so you have the REITs buying it, or the sovereign nations buying it, or, you know, these are $300 million packages to $1 billion packages. So these are, it's a whole different style of underwriting, but the requirement of the ability to repay still remains, and enforced by the US government at the end of the day. So the question is how do you qualify for silo number 2? And here are the different ways. They've gotten really creative and they kind of make sense in a lot of ways. The first way to do it is what's called a bank statement loan. And a bank statement loan is where we're going to collect either 12 months of bank statements or 24 months of bank statements, and we're going to identify the deposits that are made into that account every month, and we're going to call that income. Because theoretically, if you've got deposits coming into a bank statement, whether it's business or personal, that could be, and most likely is, a form of income. And so it's up to the underwriter to then judge the type of business that customer has. So if the customer is a consultant, for example, and he only needs a computer, a pad of paper, and some envelopes and stationery to run his business, that's a very low expense ratio. So for every dollar that goes into that customer's bank account every month, the expense ratio might be as low as, say, 15% goes to expenses. And so they would deduct from 100% of that income 15% and give them credit for 85% of that as their income. And then they'll average it over 24 months or average it over 12 months. And in some cases, we have lenders that'll just take 3 months of bank statements. So it gets more aggressive as time has gone on. Now, if the company happens to be a manufacturing plant where we've got a huge manufacturing building, we've got 200-300 employees, we have heavy capital investment in equipment and in machinery, then they're going to look at those bank statements and say, man, you've got a lot going back out. We're going to hit this by 50% or even 60% and only give you credit for 50% of those deposits coming in for your income, or even 40% of credit for those deposits coming in. But if your income is $2 million a month, that's more than enough to qualify. Does that make sense? So every scenario is a little different, but that's a method to qualify a customer without showing tax returns to still get a home loan. Another method to do it is a 1099, and listen up for you realtors, because I believe you are still on a 1099. There's a loan out there called a 1099 only that will not ask for your tax returns. And the reason that's important to you is because if you are deducting expenses on your tax returns, in this particular case, the lender's not going to see it. So they will give you credit for 100% of your 1099 income. So there are different types of sales industries where the salesman gets a 1099 at the end of the year. And in this particular loan, he would get 100% credit for his 1099 income, because they're not going to ask for his tax returns and they're not going to see all those expenses that possibly could be written off. So that's a pretty cool loan. We have a lot of investors that use that loan. The next one is called an asset qualifier. And an asset qualifier would be where, let's say you've got $3 million sitting in a bank account somewhere. We can take that $3 million and we can divide it by 60 months, or we can divide it by 120 months, depending on the lender and the loan. And that number would be the customer's income to qualify for the loan. So retired people are excellent for a asset qualifier. Wealthy people are excellent for it. And some wealthy people that have, let's say, they own 10 different companies, and that would require 10 different sets of tax returns, and then all the K-1s to match, and the profit and loss statements for all those 10 entities. we might be looking at 50, 60 documents, and they may say, hey, look, just give me the asset qualifier loan. It's much simpler. I don't have to go through the brain damage or the headache. Divide, my $5 million that's sitting in my bank account by 10 years. That's your income. Let's call it a day and move on. So we have customers that don't need it that use it, and we have customers that obviously do need it that use it. Cool program though. And then we can blend these bank statements and asset qualifier techniques together in a loan. And we can also add Social Security income, child support, rental income, and we can build a file, and we can build up the income at the end of the day to make it work without any tax returns, which is pretty cool. And then the last big program in that silo is called DSCR, which stands for Debt Service Coverage Ratio. This is a loan for investors. So if you own your house now and you want to go buy another house and you have a 20% down payment, but your tax returns are not going to support you buying another house as a rental, this particular loan program will use the future rents as the income for repayment. So they don't need your tax returns. They will need some reserves, but generally it's not too bad. It's I would say most cases it's 6 months reserves. It also kind of depends on what your down payment is. If you're putting 50% down, the bank's going to be less concerned about reserves if you're 50% invested in the property. But if you're putting 20% down, like a normal loan, then they may want the full 6 months reserves. But the investor cash flow program is really cool because anyone that with a decent credit score can get that loan for an investment property. And they will use the income, the future income, to qualify. Any questions on that? Okay, so I hope somebody's learning something out there. There's no questions, so it's really quiet on my side. So anyway, let's move on to silo number 3. So this is a really fascinating product. So let's look at America and the government as a whole. And the government wants all home owners that want to own a home, or all families that want to own a home, all people that want to own a home, to have access to financing to buy that home. I'm going to go out on a limb and say that it's a form of social control to keep peace and harmony in our turbulent world. If you own a home, then you have a place of pride and ownership. You have a home to go home to raise your family. You have a mortgage, therefore you've got to get to work the next day to pay that mortgage. And I think there's a lot of benefits, societal as well as family, reasons to own a home. So knowing that, if you don't qualify for silo number 1, and if you don't qualify for silo number 2, but you're still a good borrower, you still want to own a home, you still have the 20% down payment for a home, then there is a third or final outlet for a fairly decent home loan, and it's through the United States Treasury. Now, looping back to the institutional Chase, Wells Fargo, Citibank, etc., they do not dabble outside of silo number 1. Okay, so they're limited from the get-go. Mortgage banks, i.e. New American, we're built to do home loans, and we are built to accommodate all types of borrowers. So we offer silo number 1 and silo number 2. And we offer this silo number 3. And this silo number 3 is a very little known and little used loan. And it's called the United States Treasury Community Loan. And what it's designed for is for a person that has they've actually lowered these credit scores to 620. I need to update this slide. It's just recent. But if you have a 620 credit score or higher, I'm sorry, I meant a 680, excuse me, not a 620, a 680. So we're working with a 680 credit score or higher, and you have 20% down payment, and you cannot qualify in silo number 1 or silo number 2, then silo number 3 is your loan. The way it works is it's a community loan underneath the umbrella of the United States Treasury for, you ready? The underserved. Now, the underserved is defined as a ready, willing, and able homeowner with decent credit and 20% down payment who cannot get a loan in bucket number 1 or silo number 1 or silo number 2. Now, the loan goes up to $3 million. So a pretty well-to-do individual can get this loan. We do these loans in the $1 million frequently, surprisingly. So this loan is available. It's out there. It's available to all borrowers. And if you don't fit silo 1 or silo number 2, I call it kind of my backup loan or the last stop loan. Now, you could make the argument that there's one more stop for a loan, and that would be hard money. Hard money is actually private money from a private individual or a group of private individuals who have collected and pooled their funds together under a company name, but it's still individuals and it's private money. Hard money generally comes with 3, 4, 5 points, and you're always going to be looking at a higher interest rate than these other 3 buckets. So silo number 3 almost acts like hard money, but it's a much better price loan at the end of the day, and it's a government sponsored loan too. Probably in the back of your mind, you're saying, I want the cheapest loan that's available. And I want to take just a brief moment and talk to you about what cheap means. And I want you to look at this from the perspective of the lender. Okay, so in silo number 1, the lender is Fannie Mae and Freddie Mac. The lender is a government sponsored enterprise. The lender is there to accommodate all Americans from the West Coast to the East Coast in every state to buy a home. They are the most conservative guidelines because they require tax returns. So therefore, the interest rates would be commensurate to the risk to the lender. So if you're getting tax returns and pay stubs and W-2s and 1099s, and you're documenting it to the 1,200 pages plus, then that's a fairly well underwritten loan, and it should pay itself back. Therefore, it's a lower risk. Therefore, you're going to get Fannie Mae and Freddie Mac's pricing. Now, if you don't qualify for that pricing because you don't have the tax returns, then think about this. You're probably writing off a huge amount of expenses. So you're paying the IRS a very low tax at the end of the day. So if that's the case, and the bank now can't see your tax returns in silo number 2, and they're going to underwrite off your deposits, then that risk inherently is higher than silo number 1, and therefore the interest rate or the return to the investor should be higher in silo number 2. Now, I'm going to go out on a limb here, and I'm going to say that a 10% interest rate on a home loan is still far cheaper than paying the IRS 35%. Does that make sense? So borrowers come in all different types of sizes and shapes and industries and the ways they're paid. And all borrowers have tax returns at the end of the day. The question is what's being shown on the tax returns? And so if a borrower's got heavy expenses and paying very little in IRS taxes, then I'm going to go out on a limb and I'm going to say a 10% interest rate on a $500,000 mortgage is cheap, or even $1 million mortgage is cheap. Because if you add up what the tax bill was supposed to be, it's going to far outweigh a couple percent on a lower loan amount. And then your last stop, of course, silo number 3, they're really going blind because they're not getting hardly anything. All they're getting is your investment of 20% down and a 680 credit score. And with those two things, you can get into a home loan up to $3 million. And that in itself is even a higher risk loan, but it's sponsored by the United States government, by the US Treasury, and it's an acceptable loan and it works. So if you're at a, 9% interest rate, I'm going to go out on a limb and say it's cheap, really, in the big picture. Now, consumers want to compare that to Fannie Mae and Freddie Mac and silo number 1, and you're comparing apples against oranges. You can't compare them, but that's what consumers do, and they do it all the time. And so we just have to say, yeah, let's get your tax returns in a position to qualify for silo number 1, and we'll do silo number 1 all day long, not a problem. So that's silo number 3. That pretty much wraps up the loan process in itself, the documents that are needed to be gathered, the 3 silos that are available to all consumers today. New American Funding, and just give you a little background. We are JD Powers rated number 1 in servicing. We took that away from Loan Depot, Quicken, took that away from Quicken. And the other thing is we fund more low to mod income loans than all the other 10 banks put together. And what that means is we're loved by the government. And you can Google Patty Arvielo. It's spelled A-R-V-I-E-L-O, Patty Arvielo. Please Google her. She's a dynamo. She is very well respected in the mortgage community. She is loved by the United States government for the work that we do in low to mod income borrowers. We have her passion is for all home borrowers to be able to get a home. She feels that that's how homeowners build wealth, and she's just fabulous. So we had a question, will the slides be sent after the presentation? Elsie, I believe that the slides will be sent, and there was a couple attachments that I had sent her, some handouts. There's a handout on the financial needs list, and there was a handout on the loan process. It's everything that's in the slides, but you'll have that in more of a handout form if you want to use with your customers. What else could I hit on? New American Funding. So we have silo number 1, easy peasy, do it all day long. We have no overlays, most aggressive. We close our loans. We can close in 15 days. It's not uncommon to close in 15 days. The reason is because we're built for efficiency. We're built for speed. We are not a big banking institution that takes 3 months to get a loan through the system. We know that our reputation is built with the realtors by closing loans and having all the loan products to close a loan. I did not mention DPA programs, which is down payment assistance. What's cool about New American Funding is we have all 3 of the down payment assistance programs here in the state of California. Most lenders out there will tout that they have a down payment assistance program, but they'll only have one. The reason they'll only have one is because they're a pain in the butt to do. They're a pain in the butt to manage, and they're constantly changing. So we have graciously accepted all 3 with the reasoning of Patty saying we want everything available to our consumer at the end of the day to own a home. And so down payment assistance programs, we specialize in. We're not afraid of them. They're extra work, not a problem, but we can help with any customer that needs that kind of support. We have that available. If you're wondering about the jumbo loans, we have the in-house jumbo product that is purchased by Goldman Sachs. So Goldman Sachs is a institutional investor on Wall Street. We underwrite to their parameters. We can close that loan in 25 days. Jumbo loans take a little longer. They're a little more complicated. The underwriting guidelines are, it's a different type of underwriting. When you do Fannie Mae and Freddie Mac underwriting, we use a computer system called AUS, which is the automated underwriting system. And what we do is we literally take an electronic file and we press send and we send it to Fannie Mae or Freddie Mac, and it's underwritten on another computer system, and the results are kicked right back to us with the results. And then we can get those results and finish the loan. That does not occur in jumbo lending. Jumbo lending is outside of that scope and outside of that parameter. But jumbo lenders are adopting the AUS system to underwrite jumbo loans, and we actually do those. So we're in a fascinating time right now where underwriting is becoming easier and more automated, even in the jumbo arena. I can do an AUS loan up to $1 million today. I believe we might even be able to do it up to $1.5 million today. And sometimes what that means is that we don't need, even on a jumbo loan, tax returns. We only need 30 days of pay stubs and 2 years of W-2s, and we can do the loan. So things have loosened up in the underwriting world to the better on the jumbo product, because, we're seeing more and more, house prices have just shot through the roof, which means the loan amounts have shot through the roof. And oh, by the way, the new Fannie Mae and Freddie Mac conforming loan limit across America used to be $647,200. Will move sometime in January to $700,000. So that's a pretty big jump. It's a $50,000 plus jump in the conforming loan limit. We don't know exactly what the high balance loan limits will go to, but they will go to over $1 million now on a single family residence, which is pretty cool too. So that's a Fannie Mae, Freddie Mac product, but in a high balance format or style, which is anything over 700,000. Email me, text me. I'm always available weekends. Thank you all very much. Hope to hear from you soon. Call anytime.